You are listening to Golden Rule Radio, your weekly recap of the precious metals markets. Miles and Tori here. The absent Rob is here in spirit. And Miles, if you can give us a weekly recap.
Beginning with gold, up a few bucks since our recording last Wednesday, around 33.60, although climbing and probably a couple bucks more at this point. So not too much movement if you just look week to week, but we did have a pretty significant decline and then a bounce back over the weekend with gold down as low as 32.40. At
3,240, right?
Yeah,
not to be confused with the silver numbers.
Thanks for that. Appreciate it. So yeah, we had like a $120 drop, $120 rise in gold as it bounced what looks like might be making a nice little wedge pattern in the gold price. Moving over to silver and sliding that decimal point over like you just did for us. Silver's up about 0.5%, similar chart to gold, currently sitting at $36.60 an ounce. And just like gold, we had about a 4% swing down and back up. Moving over to platinum, platinum's up about 4% since our recording last week, sitting at $14.33. Now, what's interesting about platinum is when we woke up Monday, it was way down, and when we went to bed on Monday, it was way up. Platinum had about a 9% swing in a single day on Monday this week. So very volatile in both platinum and palladium, up slightly more than platinum, 5.5% since last week, but pretty significant move up, about 9% in a single day in palladium, and has meandered its way back down, trading a little bit more reasonably today. So we've seen some pretty significant moves in the white metals, both platinum and palladium, with, I would expect, some geopolitical reasoning behind it, and a tepid but continuation rise in both gold and silver over the last week, something they've needed as they're extending their summer vacation a little bit here. All that's on the heels of the S&P up 1.8% to 6,225 on the S&P this week. The S&P did put in a new all-time high. And finally, let's get optimistic here, and I think the theme of this week's show, the dollar index down another 0.5%, 96.75, and boy, there's a lot to talk about here with the U.S. dollar.
Yeah, you don't want to end your weekly recap with an optimistic statement about the dollar because there's just nothing optimistic to find about the U.S. dollar. But before we move on, let's do a little bit more of a recap just in terms of the quarters. These are fun charts to look at too if you have a chance to view the quarterly charts on the metals. Gold up 5.7% for the quarter. Silver up 6% in the second quarter alone. Platinum led the charge, an incredible 34% boost this quarter.
Just in one quarter.
In one quarter. Platinum's up 47% in 2025 so far. So obviously the majority of that coming in the second quarter here. Palladium up 10.8% in the quarter. It's up just shy of 20% in 2025, which sounds incredible, but that 20% is actually still lagging gold, which is 25.6% in the year. So in the first 6 months, silver's up 24.7% in 2025. So what an incredible recap as far as where all of the metals are. The white metals have really come to life, and I really call this quarter the quarter of the white metals because we've seen this resurgence here.
Well, and we're seeing consistency in that too, especially in gold, which was up over 27% in 2024, and like you said, another 25% so far this year. So if you look year over year, I think we're about 41% in gold since this time last year, and similar story in the other white metals.
You're up over 22% year over year in silver, 35 in platinum, 12.5 in palladium. So that's a great annual return. But you're getting a lot of that here just in the first half of 2025. But that's on the heels of a great 2024 for both silver and gold. Platinum and palladium, not so much. They didn't have great years. But with this recent spike in price, this activity, what you will see a lot of times is a separation from the moving averages when you get this almost kind of parabolic move up. Imagine if you have, like a 20-day, 50-day, and then the big dog, the 200-day moving average for these metals.
For those curious, the concept of a moving average is exactly what you might be picturing in your head. It's an average that moves. So every day we add a new number and then we subtract the oldest number. So it's today, a 50-day moving average is today, and then the previous 49 days. So what that tends to give you is ironed out view of a chart. And then the longer timeline you look at, it tends to give you a much broader average. So we're big fans of looking at moving averages within a couple different timelines. If you want to look at a real short average, a 20-day moving average, the 50-day gives you a real good snapshot of the trend of a particular investment over a short to intermediate time. And then the 200-day really tells you what's your macro trend over the last 6-8 months. So all of these we've been seeing rise. That 200-day is a big ship and it takes a while to get it moving. And with the growth we've seen in things like gold and silver here recently, the current price is significantly higher than some of those longer term moving averages like the 200-day, which is still sitting under 3,000 an ounce. So Tori, there is an argument that from time to time, price will revert back to those averages. You know, it's like kids playing in the park. Eventually, you got to go back and tag mom just so she knows you're still around. And eventually, the markets will move back to those moving averages occasionally. And anytime you see pricing extend far above certain thresholds, really with any charting indicator, it starts to add credibility that there could be some type of event that's going to tend to calm things down.
Yeah, the recent short-term flattening out, I know we've had a lot of volatility in gold, but the flattening out here, this sideways chop, really since late April, has caused those moving averages, the 20 and the 50-day, to kind of flatten out. But gold has recently come down below those, whereas the white metals are far above their 20-day and 50-day in many instances. So silver, platinum, and palladium, does it cause you concern? I mean, are they going to go tag mom in the park here, or does that necessarily have to happen? You know, are they going to keep on going and no cause for concern?
It's a good question. I think there's a fair argument that's continuing that we've been looking at for a while, that gold is still leading the precious metals charge. We've had gold move first. We've had gold move more. We've had gold extend beyond previous all-time highs. The white metals are still primarily playing catch up. You know, certainly when you're looking at the entire bull market, which for gold started at the end of 2015 and really kicked in around 2018, 2019 when it started breaking above those previous highs. It's not surprising to me that gold has been forming this wedge pattern recently over the last couple of months after we took this last run up. The wedge in gold is a great pause in a bull market push that allows some of these moving averages to increase to catch up with the price of gold, allows things like relative strength index, the RSI, to calm down, and divergence against different indicators to calm down. It really allows traders to just take a pause in the futures and options markets, as well as in the spot price and what we do in physical metals, and see where the market consensus is for the price. Now, what we're seeing is the market consensus is saying, yeah, gold above 3,000 seems fair, because typically corrections happen one of two ways. They can either happen real quick, where you get a significant and rapid decline back to sell off some of the overexuberance of the previous leg of the bull market, or you can have this extended period of time where the market just catches its breath, which is what we've seen in gold. And now we're seeing kind of a shortened version of that in silver just starting over the last couple of weeks. So silver's been treading water here in the mid 35, 36 range. And platinum looks to me like it may be moving into that here in the near future. Platinum's put in what could turn into a double top, although the second hit just happened today and you can't really call it quite yet. But it could turn into a double top. You've got this massive extension above the moving averages, so they need time to play catch up. We've got divergence against the relative strength index and moving averages, and there's a number of different technical indicators that people pay attention to that are all saying pause or correction. And given that gold took a pause, silver took a pause, I'm going to go ahead and roll the dice that platinum may not be coming back to 11 or 1200. We might just sit at 14 or 1500 for enough time for these things to kind of iron themselves out.
It all depends on the underlying fundamentals in terms of economic news. Some of this can be mining constraints. We know there's a platinum shortage in terms of mining supply versus physical demand. But it really brings up the point that the white metals, in our opinion, are commodities. Gold is the money metal. Gold is the asset preservation saving tool that really hedges you against this irreversible trend of dollar depreciation. But just remember, the white metals are great devices. They're great short-term parking places that when they have these types of runs, if you convert them into gold, it's going to acquire more ounces of gold in your portfolio. And for me, I'm a gold bug. It's all about how many ounces of gold do I have when I go to retire, because gold is guaranteed income when you need it. I'm not saying that the white metals aren't. You're still owning the physical, tangible commodity. But in times like this, if there is a suspected pause or even a retracement, those white metals are performance-based. To me, it's like owning a stock in a sense. And then you park it into your asset preservation tool, which is gold. And it's an excellent device. So case in point, let's look at some ratios. The gold to silver ratio right now, we're at 92 to 1 today, just taking the gold price and dividing by the silver price. And that means you should still be buying silver. From a ratio standpoint, we're still adding heavier to a silver position than we would otherwise normally add, because it is going to end up giving us more ounces of gold later. The platinum gold, that's tough. So now we're in this weird situation where it's like, look, I'd rather hold that platinum until it really trades straight across 1-to-1 like it did for decades. But we have this short-term run. Do we sell some here, trim some of the position, take the profits and run? And it's a tough thing to say. And then finally, a key ratio is the Dow to gold. So you've talked a little bit about the S&P hitting an all-time high. The NASDAQ, I believe, also did. The Dow, they've also had excellent quarters. The equities markets have revalued from a dollar depreciation. But the Dow gold ratio got as low as 11 here in this cycle. We're now just over 13 to 1. That's still not an overbought gold position. Gold is not overvalued versus those equity markets. Until that gets into single digits, that's a key ratio that gold is not, in my opinion, overvalued yet. But in terms of the US dollar, Miles, I think it's really key to transition over to that and do a deeper dive on its recent trend.
I think that Dow gold ratio says a lot to me, because scrolling back over the relative price of the stock market compared to gold, going back through history, initially the Dow Jones Industrial Average was set up at a 1-to-1. Each of the 12 shares in the Dow Jones Industrial Average costs you 1 ounce of gold. So it was set up at a 1-to-1 price. Over the last 100 years, we've come back to 2-to-1. We've come back to 3-to-1. We've come back to 1.5-to-1. So you do see a reversion back to the mean of what it was initially set up to be. Now, what's interesting about that is the Dow is a lot bigger than it was. It's not 12 companies anymore. It's 30. We're still seeing a increase in the size and the potential scope of the equities market, but we occasionally get that reversion back to the price of gold regardless. I'm looking at the Dow to gold ratio going, okay, 2024, you're looking at a 20-to-1. 20 ounces of gold buys you 1 share of each of the companies on the Dow. Now it's only 13. Well, we see a reversion down to 1 or 2 or 3 or 4, and you're still looking at a pretty significant opportunity to, believe it or not, Tori, can you believe I'm going to say this? Take profits out of your gold and move into the equities market at that point. This is where the triangle concept comes in. The idea of rebalancing your portfolio from time to time to make sure that you're covering the mandates of liquidity, growth, and preservation. So there is some grand strategic purpose behind paying attention to not just the fun ones for us. How do I turn 50 ounces of silver into 2 ounces of gold instead of 1? But on a grand scale, you can take these same concepts and you can build them into your portfolio as a whole and start incorporating the other asset classes that you may want to be a part of.
Yes.
So Moving over to the dollar, I loved a second ago when you talked about gold is the money metal and all the other things are just sort of roads that lead to gold. Well, the dollar is the money, and all the other roads are leading back to the dollar. In stock investing and real estate investing and anything else, we always price things mentally. We always think, okay, how many US dollars is this worth? And what's a fun transition is when you start thinking to yourself in terms of relative value. How many ounces of gold is this worth? How many gallons of gas is my time worth? How many cartons of eggs is it worth? And with the way the US dollar is going right now, I think we may start thinking more in terms of how many hours I have to work per carton of eggs instead of US dollars. The US dollar, as of this week, has now given up all gains on the dollar index made from the day we started raising interest rates to current. So the dollar index has now lost all of the momentum it had with the interest rate rises. So here we are back to a devalued US currency at higher interest rates.
Yeah, that's not a good setup. And the real inflation numbers will prove that the cost of living from 2014 to 2024, over the course of a 10-year period of time, the cost of living doubled, which means the average inflation rate, unstated but measured the way it used to be measured, was about 10% a year. Well, guess what? The US dollar's lost 10% of its power this year alone already. And that's the worst first half performance in nearly 40 years. So you're almost seeing an acceleration of the weakening. And we know President Trump wants a weaker dollar. He's getting it without the Federal Reserve cutting rates. When we increase the Fed lending rate or interest rates, that's actually strong dollar policy. Okay, and when that happens, things should usually get a little bit cheaper. Gold certainly does as the barometer. And then when rates get cut, gold gets more expensive because the dollar gets weaker. They haven't even cut rates yet. And the Federal Reserve says, well, it's a wait and see type game. They still feel as if tariffs are delaying their ability to cut rates. But I think the intention is that they will cut rates. There have been 64 other rate cuts around the world by other central banks so far in 2025, 0 in the United States. Maybe that's good. Maybe it is keeping inflation in check. Those inflation numbers ticked up just a little bit, but none of the fear and the implications that we thought we were going to see from a tariff standpoint really are playing out. But that's just one fundamental, Miles. I mean, in terms of all the different fundamentals that move gold, the reason that you own gold certainly is monetary policy. What is the dollar policy? Well, the M2 money supply, the global US dollar money supply, is now at an all-time high. So it's not good when there are more dollars in the system because that means each dollar buys less. The U.S. M2 money supply jumped 4.5% year over year, just measuring through May. So it's at a record $21.94 trillion in circulation. And that's the 19th consecutive monthly increase. We're not in war. We're not in an economic crisis, but we're spending like we are. We're quantitative easing as if we are. So now it's surpassed the previous all-time high of $21.86 trillion from back in 2022. That just bodes very, very poorly. The U.S. dollar's purchasing power is in an eternal bear market. And that's why you look at that long-term chart of gold and why it, over my lifetime, over your lifetime, it's been in this eternal bull market.
What's interesting to me about that is the eternal bear market of the US dollar. That's not like a fact. That's the stated policy. That's the goal. The goal is the competitive devaluation of the currency for the sake of international trade.
It's not a symptom. This isn't something they can't control.
No, it's
something
not a
they're
symptom.
causing.
It's the goal.
Yeah.
I don't know if you've had the chance yet, but the interview that David McElvaney did on the McElvaney Weekly Commentary this week was one of the best interviews I've heard in a very long time because it's a discussion on the concept of economic warfare internationally and what that has and currently looks like. But there was a clip I pulled out of that stuck with me, and it's the idea that when you close your borders to things like trade and money, and that stuff stops crossing borders, that's when militaries and missiles start. And there's something to be said for this trade discussion that we seem to be, from a charting and economic standpoint, tightening down the trade discussion and competitive devaluation of currency when that becomes the goal through taxation like inflation, it's no wonder to me that this experiment that we've tried for the last 40 years that everybody knew would fail eventually because we're not the first civilization to try to get off the gold standard. And guess what has a 0% success rate? Getting off the gold standard.
Fiat currencies.
Yeah, so it's no surprise to me whatsoever that while we're still lower interest rates and give people the opportunity to borrow at lower rates and yada yada, even though the price of inflation is more than compensating for the decline in interest rates, on the long timeline, you end up just treading water. But over here, secretly, sovereign banks have been dramatically increasing their own gold holdings. It's like, okay, we tried this short experiment that lasted for 20 or 30 years, the 80s, 90s, early 2000s, where we tried to have gold just be an asset. And gold is not an asset. It's not a volatility hedge. It's not an allocation. It is the base money of the financial system, always has been and always will be the thing that we revert back to.
Yes.
As the stable means of exchange that everybody can equally trust.
And that's why they're comfortable leaving the U.S. dollar. The U.S. dollar, through those currency wars, through the trade wars, we're losing the bully stick in a sense. As the dollar gets weaker and there's more of them, people end up actually wanting fewer of them. And that is the issue, is that you're just seeing this reality of going back to real money. So whether it's a strong dollar or a weak dollar, low inflation, high inflation, it doesn't matter. Gold is rising in all of those scenarios. And this is a central bank and institutional money-driven gold price phenomenon. This isn't the retail investor. This isn't Main Street speculating on the gold price. In fact, a lot of people are still on the sidelines wondering, is it too late? No, gold's not in a bubble. You have to understand this. This is just getting started. This is a paradigm shift. And gold's value today is merely a fraction of what is to come, because this sea change from a de-US dollarization into gold is going to continue. And we can focus on short-term news. We can narrow our focus to a quarterly chart or a weekly chart. But when you zoom out, you really start to understand what's transpiring. Our debt issues are just an example. The world debt is at a record high, well north of $300 trillion. Everybody has to try to print their way out of this. Everybody has to try to find an alternative to the fiat currency system so that you don't become absolutely worthless. You have something of value. So for those of you thinking beyond the next trend or miracle stock or whatever you're doing, you're not even close to too late. You're right on time right now. This is a perfect opportunity to be adding to gold, and maybe you're doing it through the white metals like we talked about. Maybe the more undervalued metals are going to allow you to catch up if you haven't gotten started yet, so that you can ratio trade out of those white metals into more ounces of gold and get that compounding effect.
Yeah, I love that, Tori, because if you have a problem buying gold at $3,350, why don't you just pay $2,700 for it by buying silver?
Exactly.
You can buy silver off of the price ratio differences right now and swap it into gold when we get back to normal pricing between the two. When silver finally plays catch up, you're not paying 33, 34, 3500 for gold. You're paying 26 or 27. So it feels much more reasonable when you actually take the time to go through this thoughtfully, because the scary thing that you hinted at there that we haven't seen yet, when the general public decides we're all going to start marching towards the same thing at the same time, it gets real ugly real quick. I don't know anybody who's a thoughtful investor that wants to be fist fighting through something like that. And the things that cause this to happen, I don't see any reprieve for it coming either. We talked about the concern over the interest rate and how that really has no effect on the decision making of Washington. And lo and behold, in a 51-50 vote, at least in the Senate, we've passed and moved on the big, beautiful spending bill that I would argue a pretty serious leap of faith in order to say that the amount of revenue that these policies will generate is going to outpace the expense that it's going to add to the national debt.
Because our national debt is at $37 trillion. With the passage of the big, beautiful bill, the Congressional Budget Office predicts that by 2035, the national debt's going to be between $59 and $62 trillion. again, you see why central banks and large institutions are buying gold. Our annual deficit's over $2 trillion. You don't fix that with one bill. You don't fix that with one presidential term. The interest on that debt's over $1 trillion. Gold at 3,350 is just a reflection of this terrible debt foundation beneath this global currency and credit system that we're all suffering through. And it is not too late to be adding to your ounces. You ought to be doing it on a monthly, quarterly, and annual basis as it is.
So that's going to do it again this week for Golden Rule Radio. As always, we appreciate you stopping by. If you'd like some more info, we encourage you to head on over to our website. That's McAlvany.com, McAlvany.com. You can also find us on Twitter at ICA Gold or Facebook at McAlvany Financial. And as always, if you'd like to discuss your personal portfolio, you can give us a call at 1-800-525-9556. Thanks for listening and have a great week.